real household consumption spending has been flat as a pancake. There's been no growth in real household spending since the pandemic. £750 billion. In total, it's 1.3 trillion. So these are enormous numbers. They're completely ignored by consensus economics.
They seem to be looking at the same data as you and just drawing the opposite conclusion. They see it as the new normal, whereas you see it as a dam waiting to break.
All of these little facts give me confidence that consumers are going to do what I expect them to do.
If Neil is right about the consumer, the UK market has a tailwind that almost nobody is pricing in. This week, UK unemployment hit its highest level in 5 years. Every headline says the same thing. The UK economy is in trouble. But sitting next to me is a man who spent 30 years managing money through recessions, crashes, and crises. And he thinks the exact opposite. He thinks the UK consumer is sitting on a coiled spring, and when it releases, it could change everything. If you watched last week's episode on UK regulatory reform, first of all, thank you. The response was incredible. We talked about the UK stock market being stuck in Division 4 and what's actually being done about it. But today we're going to do something that connects the conversation and takes it somewhere quite different, because last week was about the structure of the market, the plumbing, the rules. Today is about the fuel, what actually powers an economy and why it matters to you if you own shares in UK companies. By the end of this episode, you'll understand 4 things. 1, what actually drives the UK economy and why it's different from most other countries. 2, the mechanics of how interest rate cuts feed through into economic growth and eventually into stock prices. 3, why Neil thinks the Bank of England has got its forecasts badly wrong and what the data actually shows. And 4, why all of this matters to you right now, this year, as someone who might invest in UK companies. Neil, good to see you again.
Good to see you, Joe.
I want to start this week with a number that everyone has probably seen. UK unemployment at 5.2%. It's the highest reading since the pandemic. Youth unemployment is also up at 16%. Markets are now pricing in an 83% chance the Bank of England will cut rates in March. And every headline I've read this week has been pretty gloomy. What do you think about things?
There's a lot there, John. Let me start with the unemployment data. Yeah, it's true that unemployment has risen in the UK and it is at a 5-year high. The last time it was this level was in around the pandemic. Now, 5.2% is a number that the government will feel quite uncomfortable about, I'm pretty sure. But it is the inevitable consequence of a couple of things. The first thing is that the government introduced in its first budget and, frankly, as well in its second, measures that increase the cost of employing people, basically. And it's quite clear that when you increase the price of something, typically economics tells you that there's less demand for it going forward. And that's exactly what I said would happen as a result of the measures that were introduced in the 24 budget. Massive increase in national insurance, for example, employers' national insurance, for example, big increases in the minimum wage subsequently. As a result, UK unemployment would rise. That's one factor. So frankly, the inevitable consequence of government policy is higher unemployment, point one. And even Catherine Mann on the MPC agrees with me on that point. She made a speech. She's one of the biggest hawks, probably the greatest hawk on the MPC at the moment. And she pretty much said that, I think, in a speech last week.
Well, before we get into Neil's thesis, I want to make sure everyone watching this understands the machinery we're going to be talking about, because we are going to use words like GDP, consumption, savings ratios for the next 40 minutes or so. And I think a lot of people hear those words without really understanding how they all connect together. So I'm going to take a couple of minutes on the basics. When we talk about the UK economy, what we're really measuring is GDP, gross domestic product. It's the total value of everything the country produces in a year. You can think of that like the economy's scorecard. Now, GDP is made up of 4 things. Household consumption. That's what ordinary people spend. Your weekly shopping, your rent, your mortgage, your car, your holiday. Then there's government spending. Then business investment. And finally, net trade, which is exports minus imports. Here's the thing that matters for everything we're about to discuss. In the UK, household consumption, people spending money, is roughly 2/3 of the entire economy. 2/3. So everything else, government, business, trade, shares the other 1/3. So the UK economy, to a degree that I think surprises most people, basically is the UK consumer. If households are spending, the economy grows. If they stop spending, it doesn't. Neil, is it really that straightforward?
The most important, as you say, is the household sector. It's 2/3 of the economy. That's normal for most developed economies in the West. In China, it's a very different relationship. Household consumption is only about 40% of the economy. But anyway, you're right. Those are the key elements, and the key driver really is consumption. It's worth making one point, okay, which I think people consensus economics just completely overlooks. Since the pandemic, real household consumption spending has been flat as a pancake. There's been no growth in real household spending since the pandemic. Government consumption and investment spending have both increased significantly in real terms since the pandemic, but household consumption has been completely flat.
And when you, Neil, when you say in real terms, just put that into plain English for us.
So that's adjusted for inflation. So if you take inflation out of the data and just look at the economy without the impact of inflation, you can see there's been no growth in household consumption since the pandemic, which is an extraordinary situation, really, when you consider that there's been decent real income growth over that period, for example. One of the most interesting things, really, that I think that people overlook is that people look at the US economy and think, well, it's grown really, really well since the pandemic. The UK economy's been flat as a pancake. It has grown, but not as fast as the US. You know, there must be some sort of inner dynamism in the US economy that is doesn't feature in the UK. And to some extent, you can see there are valid arguments in that. Of course, the technology sector in the US is a key differentiator. But interestingly, when you look at the savings rate and look at what's happened to the savings rate since the pandemic in the UK, over the period from 2022 to 2024, so that 2-year period, the savings rate doubled from about 5% to over 10%. In the US, it fell. It's at 3.5% now. In the UK, it's at 10. So if you imagine, for example, that households had behaved in the UK as they've done in the US, and we were saving 3.5% of our income rather than 10 and a bit percent of our income, imagine what the GDP difference would be between the UK and the US now. And frankly, it wouldn't be very different. We would have enjoyed much faster growth if the consumer had behaved in the same way that the US consumer has and saved as much of its income as US consumers have. So interestingly, when you put all this data into your sort of thought process and think about, well, what are the differences? Why has the UK economy been sluggish for the last 5 years? What's been holding it back? There isn't really, in my view, there are lots of problems. Don't get me wrong. I'm not dismissing the challenges that the UK economy confronts. But when you actually look at what's happened to the really big macro numbers, really, it is all down to the fact that the household sector, the consumer, has basically been through one of the most prolonged periods of thrift on record, and that's resulted. I'll finish it in a second, but that's resulted, John, in the biggest single deleveraging of the household sector that's ever been seen in the UK economy.
Okay, so government spending and business investment matter, but they tend to follow the consumer, not lead it. So when consumers spend, businesses invest to meet that demand, and when consumers pull back, businesses cut costs. And I guess that's why consumer data is the single most important thing to watch if you want to understand where the UK economy is heading.
That's correct. I mean, in a way, it is that big engine of growth in the UK that drives so many other things. I mean, you could just imagine what the productivity data would look like in the UK if UK consumers hadn't doubled its savings ratio, if they'd have carried on spending in the way that they had done prior to the pandemic. Um, there'd be much more demand in the economy, output would be higher, productivity would be better. I'll come on to that again in a moment. Productivity would be better, GDP growth would be better, the government finances would be better. So, this prolonged period after the pandemic, which has obviously had the impact of the war in Ukraine and the energy price, inflation, interest rate boom that took place in the wake of that war. Um, we've endured an extraordinary period of time, and it's not normal.
Okay, so this is the bit I want to really make sure that people understand, because this is the engine that drives everything else we're going to talk about today. So I'm going to walk through a chain reaction. You can think of them like dominoes if you like. And I want you to picture them falling one into the next. Domino 1, the Bank of England cuts interest rates. When that happens, two things change immediately. The return you get on your savings goes down, your bank account, your cash ISA, your deposit, they all start paying you less. At the same time, the cost of borrowing drops. Mortgages get cheaper, personal loans get cheaper, credit cards get cheaper. So overnight, saving becomes less rewarding and spending becomes less expensive. Domino 2, gradually households start spending more. Not overnight, this stuff takes months to happen, but the balance starts to shift. Maybe you remortgage and suddenly you've got an extra £200 a month. Maybe the savings rate on your deposit drops and you think, why am I leaving all this money sitting here? Maybe you just feel a bit more confident about the future. Whatever the trigger, money that was sitting still starts to move. Domino 3, that spending becomes someone else's revenue. And this is the bit that people forget. When you spend money at a restaurant, that's revenue for the restaurant. When you buy a car, there's revenue for the dealership. When millions of people across the country start spending a little bit more freely, company revenues go up. Not because anything magical happened, just because the money is circulating again. Domino 4, higher revenues lead to higher profits, which leads to more investment and more hiring. Businesses with more revenue become more profitable. They invest. New stores, new equipment, new capacity. They hire people. That creates more wages, more confidence, more spending, and the cycle starts to feed itself. Finally, Domino 5, the stock market follows earnings. And this is the final link. Share prices are ultimately driven by company earnings. If UK consumers are spending more, UK companies earn more, especially the domestic-facing ones like retailers, housebuilders, banks, hospitality. Their profits go up, their share prices go up. So that's the chain. Rate cuts make saving less attractive and borrowing cheaper. People spend more. Companies earn more. Stock prices follow earnings. And in the UK, because the consumer is 2/3 of the economy, the effect is enormous. Neil, does that match how you've seen it play out across the cycles you've managed money through?
Yes, it is. It sounds relatively simple, doesn't it? But it is exactly what you just described. And the UK economy is a particularly good example of how that mechanism works. It's worked very well in the past when the economy has grown well, and I believe it will do so again in the future. And I think it's about to do so. And just to put some data on some of those numbers, and just to give you some idea of why I'm getting increasingly confident that I'm right and consensus is wrong. I think you can already start to see the early signs of lower inflation and lower interest rates already having the sort of impacts you've just described. And despite 5% real income growth in those 2 years, consumption growth was actually negative in those 2 years. It over the 2 years it fell by about 0.5%. Now, just to give some context to that, consumption growth per annum, real consumption growth per annum in the 10 years up to the start of the financial crisis was about 3.25% per annum. And if you take the period after the financial crisis up to the pandemic, that period was characterized by consumption growth per annum of about 2% per annum, even through that sort of post-financial crisis period. So a 2-year contraction of 0.5% is pretty outstanding. I mean, it's outstandingly bad. As we know, interest rates were going up significantly during that period between 2022 in the wake of the war in Ukraine. And of course, they started to come down in 2024, and that fall in interest rates gathered momentum last year. Now, so consumption growth, real consumption growth was negative over the 2 years, 2023 and 24. But in 2025, as interest rates started to come down, consumption growth grew by 1%. And that gives me encouragement that the savings boom that was triggered by those events has started to sort of dissipate. And the savings rate actually fell last year a little bit. Consumption growth picked up. So all these little straws in the wind, I think, are very significant to tell you what's going to happen next.
Neil, this is where we get into your actual view, and it's fair to say it's not what most people are hearing right now. We've been talking about this for the last few months now on the Noise Cancelling podcast. But walk us through what's happened to the UK consumer since the pandemic.
Well, I think the pandemic was like another sort of final straw that sort of broke the consumer. It's probably in economic terms, arguably the most significant event of my working career. Um, it was a disaster for the UK economy.
Even more than the financial crisis and even more than the dot-com bubble, all those things that came before it.
The dot-com bubble was barely a blip for the UK economy. It was an event for the stock market, but virtually irrelevant for the real economy. The financial crisis was a very dangerous event that could have triggered all sorts of incredibly sort of hideous outcomes. But central banks did have the tools to head it off, and central banks, unlike politicians, did do many of the right things at the time. Um, the financial crisis hit the UK economy pretty hard because we had such a big financial sector and such big banks, and they had been so poorly regulated in the lead up to the financial crisis. And the financial crisis blew up that bubble, and it had a profound impact on the UK economy. And we lived with the aftermath of that, and arguably still are in some respects, for a very long time. That set in train various events or changes in consumer behavior, which you can see in banking data. You can see that the sort of, for example, let me put some context. The loan to deposit ratio in the banking sector before the financial crisis sort of really got going was 150%. So loans were 50% bigger than deposits in the banking sector, in the UK banking sector, and that's households and businesses. Now, bank deposits are significantly bigger than loans, total loans. Indeed, the ratio that, as I've just said, loans were 50% bigger than deposits in about 2009, around there. Loans are now 80% of deposits. And when you consider total deposits in the UK banking system, about £4 trillion, that is a giant deleveraging, an absolutely giant deleveraging. We've never seen anything like that in modern economic history in the UK economy. And interestingly, it is completely and utterly ignored. Whenever anybody talks about debt in the UK, we always look at the public sector and say, oh my God, government borrowing is out of control. Debt to GDP in the public sector is about 90 whatever percent of GDP. This is awful. The UK is massively indebted. No, it's not. When you look at the economy as a whole, what you've seen is this massive deleveraging that has taken place since the financial crisis in the private sector, in businesses and households, has been offset, not completely offset, by increased public borrowing, because, of course, with the economy needing to have growth and employment, etc., the public sector has felt an obligation, I suppose, to keep spending, which it has done with gay abandon, as we know, and it obviously did so during the pandemic. But when you look at the economy as a whole, the private and public sector debt to GDP has been declining because of this massive deleveraging in the private sector, and particularly in the household sector. And the magnitude of that shift is about £750 billion. In total, it's 1.3 trillion if you fold in the corporate sector along with the household sector. These are enormous numbers, and they're completely ignored by consensus economics. Now, I think we're at the end of this extraordinary period of thrift in the UK economy. We have been through crisis after crisis: the financial crisis, the pandemic, the war in Ukraine, the cost of living crisis, the interest rates and inflation that exploded in the wake of that last event. And we're now unwinding all of that, I believe. And it's not all going to come with a rush, and households are not suddenly going to go from a 10% saving rate to a 5. But I think it's just going to come down bit by bit as confidence in the economy, confidence in the future starts to build. And you only need small shifts in that saving ratio to deliver significantly better consumption growth in the economy.
So just make sure I've got this right for everyone who's watching. UK households have basically been on a savings binge since the financial crisis, which was then supercharged by the pandemic and the cost of living crisis. The result is that people are sitting on record levels of savings, they've paid down debt, and they've been spending far less than their income would suggest. The question, I guess, is whether that's permanent or temporary.
Yeah, I think it's a cycle. I think it's been triggered by a series of extraordinary events which won't repeat, which won't replay. And I think a more normal situation is less saving, more spending, and that new equilibrium. The fact is still that I see saving rates coming down. I mean, they doubled between 2022 and 2024. The economy didn't get that much older during those 2 years. So anyway, I think we're still in an environment of real wage growth. Interestingly, particularly in the public sector, which is seeing wages grow at twice the rate of the private sector, 7% plus 3.5% in the last 3 months of last year. Now, wage growth is slowing, so I think wage settlements are about 3%, which is historically consistent with about 2% inflation. But that's good real income growth for the UK economy as a whole. So for those in work, they're seeing good real income growth. Interest rates are coming down, inflation is coming down. Even the Bank of England is saying that inflation next year will be below its target. So I see every possibility of base rates being down potentially below 3% by next year. Instead of headwinds, we've got tailwinds for the consumer. And I think that the households will respond to those tailwinds by saving less, spending more. That's a natural reaction to the sort of absence of constraint, if you like, or new constraints that will evolve over the next few months.
Well, that's the thesis. The UK consumer has been in hibernation and the conditions that kept them there are changing. But a thesis, Neil, needs evidence. What can you actually point to that says this shift is happening now, not just that it might happen eventually?
I've alluded to a couple of things already, but I think just to repeat, we've seen better retail sales in December. December was expected to be very, very poor. I think the expectations were for a very depressed Christmas spending environment. In fact, retail sales grew in December. They've grown again in January. People were saying, well, Consensus Economics was expecting a sort of a hangover, if you like, from a slightly better Christmas than they'd expected. And for January to be down, January was up. So consumer spending is up, consumer confidence is up. But that's not the only indicator, I think, that tells me that I'm on the right track. We've also seen a pickup in mortgage lending growth, which fell to zero growth relatively recently. And last year it picked up to about 3% growth and 3.5% growth, and it's accelerating. Consumer credit started to grow too. So I think there are early signs of momentum in the consumer economy that give me confidence that my thesis about low inflation, low interest rates triggering this shift in saving behavior and spending behavior in the UK economy is the right one. And interestingly, actually, it looks like lending growth is about to start growing more strongly than deposit growth. That's the first time that's happened in a very, very long time. This could be the first time that lending growth has outstripped growth in deposits since the financial crisis. So I think all of these little facts are sort of straws in the wind that give me confidence that consumers are going to do what I expect them to do. Now, of course, what will also fuel that is lower inflation. We know that's coming. We've seen, we this week have seen a better January inflation number than consensus was expecting, 3%. By April, inflation will be down at 2%. The Bank of England should have cut rates 2 weeks ago. God knows why they didn't cut rates. Completely inexplicable, stupid decision, but they will cut in March. And they'll cut again in May, I believe, and I think they'll cut again later in the year, maybe in August. We will exit this year, I think, with interest rates at 3%. And we've come from a period when interest rates were over 5. So, this is a very significant transformation. These factors will be the engines of growth for consumer spending.
So you've got the forward-looking indicators, borrowing patterns shifting, and you've got the real-time data, retail sales already beating expectations, for example. These things are happening before the next round of rate cuts, which presumably just accelerates everything.
Yes. Frankly, I would have expected consumers to have been a bit more enthusiastic last year. But unfortunately, their enthusiasm was crushed by the higher taxes that followed the budget in October 2024. So that was a new headwind for consumers last year. But despite that new headwind, consumers did grow spending last year in real terms by 1%. And I should have mentioned actually that the absence of higher taxes this year is, if you like, a further boost in relation to what we had to endure last year. Higher taxes were a sort of break on consumer confidence last year. There won't be higher taxes this year on consumers.
Here's where we get into the disagreement, because, as you mentioned, Neil, the Bank of England published its monetary policy report in February. It paints a really different picture. Tell us what they said and where you think they've got it wrong.
The Bank of England has a habit of being too cautious on the UK economy in recent history. I don't really understand their methodology, their analysis. I read large parts of the February monetary policy report. It's a very boring read. I recommend people avoid it at all costs, frankly. But it is full of the usual sort of academic sort of mumbo jumbo, which to me just doesn't make sense. I just cannot see how the economy slows this year from last year. They've got a growth this year of 0.9%, and last year the economy grew at 1.3, 1.4%. Remember, last year when you look at the 2 years, inevitably there will be lower interest rates in 2026, lower inflation, no tax increases, cuts to household energy bills, slightly higher unemployment, but not significantly. I cannot see how those things result in a more depressed, downbeat consumer in 2026 than what we had to endure in 2025. Remember, for the last quarter of the year, we were being told by Consensus Economics and by every financial journalist about this £50 billion black hole in the nation's finances and how much taxes would have to increase to fill that black hole. That proved, as I said at the time, was a complete and utter load of horse manure. That was a massive headwind for business confidence and for consumers. We are not going to go through that again this year. Lower interest rates, lower inflation. Weirdly, the Bank of England doesn't think that will result in higher consumer confidence. They've got confidence staying low. Weirdly, they think that lower inflation and lower interest rates won't stimulate consumer spending. It really is a sort of nonsensical forecast. I just don't get it. I read most of the report, didn't make much sense to me. Interestingly, if you landed from Mars and if you didn't know that they had kept rates on hold, read the report not knowing what their conclusion on rates was, you would have said, well, inevitably they're going to cut rates. Weirdly, because the narrative really talks to all the sorts of things you'd think, well, yeah, the Bank of England would be concerned if that was going in the opposite direction. So, for example, their forecast for inflation was cut this year, and indeed for next year too, to below the Bank of England's forecast. And yet they didn't cut rates. Anyway, it won't make that much difference. They'll cut in March instead of February. But
Well, they seem to be looking at the same data as you and just drawing the opposite conclusion. They see the high savings ratio and they see it as the new normal, whereas you see it as a dam waiting to break.
yes, I look. It's hard to fathom what goes through the minds of the 9 members of the MPC, or indeed what goes through what 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 the model that the Bank of England used for the UK economy, why it spits out these sorts of odd numbers, why. But for me, it's not so much the analysis, it's the judgment that is way off track. I sort of look at the numbers and think, "Well, they've got that wrong," and I'm not sure that they should be that bearish about. For example, let's look at their one of the things that they were very downbeat about was, again, this productivity issue. But, as we well know, and as I've been writing for about the last year and a half, the UK ONS, the body that measures all of the things that are going on in the economy, it has been making fundamental errors and is really struggling to estimate or to work out what's actually going on in the economy. And one of the biggest things that they're failing to do accurately is measure simply the number of people in work. Now, they use a survey to make this judgment, and it's called the Labour Force Survey, and it is the foundational bit of the Bank of England, the OBR's calculations on productivity. You need to know how many people in work, how many hours they're working, and you know what the output is. Well, you think you know what the output's going to be, so you make forecasts about productivity, but you also analyze what's happened to productivity based on the number of people in work. But if you're overestimating the number of people in work, which the LFS survey absolutely abundantly clearly is doing, then you've got the wrong productivity number. And that's exactly what's now being revealed. In the latest employment data that was published this week, there was an allusion. The ONS alluded to the fact that its LFS survey was basically wrong, and the margin of error is huge. The LFS survey, for example, showed that there was an increase in employment last year of 380,000. Now, the PAYE, the HMRC data, shows a fall of 120,000 in that number. A 500,000 difference between the LFS survey and HMRC data. So when you adjust for that, if you work productivity out based on the LFS survey, you get a very different number, 0% growth in productivity. When you look at the HMRC data, hey presto, 2% productivity growth, which is the trend rate that we're all hoping to see in the UK economy. Indeed, it's what productivity grows at per annum in the US in recent years. 2% is a good number. The reality is that the productivity outcomes are much better. We've got measurement errors in the UK, but you'd think that the MPC would know about those measurement errors, but they appear not to. The big problem here for me really is that the MPC's judgment is all wrong. That's the problem. And economics and making policy decisions about interest rates is about data up to a point, but it's also then about judgment. And for me, their judgment is way off.
Okay, so we've covered the mechanics, how rate cuts feed through to spending, how spending drives the economy. We've heard Neil's thesis, the consumer is sitting on record savings and is starting to spend again. And we've heard why he thinks the Bank of England is underestimating what's about to happen. Now, I want to bring this back to the question that matters to most people watching, which is, why should I care about any of this as an investor? Especially after what we talked about last week, the UK market, it being in Division 4, undervalued, overlooked, losing companies to New York. Neil, if your thesis plays out, what does that actually look like for someone investing in UK equities?
Many of the biggest companies in the index have nothing to do with the UK economy. They happen to be listed here in the UK, but their businesses are global. But a significant part of the UK market, UK stock market, reflects the slings and arrows of the UK economy. Domestic companies focused on the UK economy form a very significant part of the mid and small cap, and indeed a decent part of the FTSE 100. So although miners and oil companies, for example, have very little to do with the UK, banks, insurance companies have a very significant exposure to the UK economy. In some respects, they're totally focused on the UK. So you've got to be careful where you invest, or you've got to be aware of what's going on in the market, if you like, but and what the companies actually do. But vast tracts of the UK stock market are exposed to the UK economy. And if I'm right, and the UK economy performs much better than consensus economics believes, much better than the MPC, much better than the OBR believes, which I think it will, I think I'm going to be right once again. And I don't think, sounded arrogant, didn't it? But I've been right before on some of these things. Then I think what inevitably that means is that if the domestic economy is stronger, profits, earnings, dividends from those domestically focused companies will be better than expected. And inevitably, you would expect that better profits, earnings, and dividends from those companies would be reflected in better share prices too. So it's an important sort of part of the thesis and the argument for investment in UK equities.
So if I'm connecting last week's episode to this one, last week was about the structural changes being made to attract companies and capital to the UK market. This week is about the economic fuel underneath it. The argument is, even without structural reform, if Neil is right about the consumer, the UK market has a tailwind that almost nobody is pricing in.
That's correct. And maybe the investors, whether domestic or international, are beginning to twig that this might actually be maybe the outcome, because the UK equity market, as we know, performed very well in 2025. It was one of the best performing developed economy markets globally. And year to date, it's outstripping once again the S&P 500, the Euro stocks, pretty much every other index globally, apart from I think Japan and Korea. So the UK has had a good start to the year. It's an early straw in the wind, maybe. We're only 1.5 months into the year, but it's been a good start.
So here's where we are. The headline this week was bad, unemployment at a 5-year high. But if you stayed with us for the last 30 or 40 minutes, you now understand exactly why Neil reads that headline completely differently. Unemployment is a lagging indicator. The leading indicators, borrowing patterns, mortgage lending, retail sales, are pointing in a different direction. The UK consumer is sitting on the largest savings surplus on record, and the conditions that kept them saving are starting to reverse. Now, of course, Neil, you could be wrong. The Bank of England might be right. But at the very least, hopefully, if you're watching this, you now understand the mechanics of the argument and you can watch the data for yourself. So here's what to keep an eye on over the coming weeks and months. First of all, on March the 19th, the next Bank of England rate decision. After this week's unemployment data, the odds of a rate cut have gone up. Watch how the vote splits. If it moves to maybe 6-3 or 7-2 in favour of cutting, that tells you momentum is starting to shift. Second, retail sales data. The next releases will tell you whether the December and January surprises were one-offs or if it's the start of a trend. Third, and this is the one, Neil, I think you watch most closely, Bank of England's loan and deposit data. When household loan growth overtakes deposit growth, that is the clearest signal that the savings glut is unwinding. That crossover hasn't happened since before the pandemic. And fourth, the next quarterly savings ratio released from the ONS. If the savings ratio keeps falling from that 10% level, Neil's thesis is in play. Neil, if you could say one thing to someone who's watching this who invests in UK equities, what would that be?
One thing. I suppose it would be this, that the UK equity market remains an undervalued market in the context of its history and in relation to its peers.
Thank you, Neil. Well, that is it for this week. If you found this useful, please do share it with someone who you think would benefit from it. Subscribe if you haven't already, and leave us a comment down below to let us know what you think. Neil and I read every comment every week. We'll be back with more next time on noise cancelling. Until then, take care.